I don't think silver's going to ever collapse again. It may collapse from, let's say it goes to $400 in 6 months and drops back to 250. Yeah, it'll collapse. But coming back down to this old reality is not going to occur. It's leaving it. It's going to much higher levels. And if you're not there for the next 6 months, I think you're going to miss it. In the last 5 months of that ongoing bull market already for silver and gold, silver went up 4.5-fold in 5 months, reaching $50 for the first time, 1980. Okay. What caused that already existing bull trend in silver to go ape on the upside and do it bam like that? Totally changed the nature of the reality that was expected. Okay. And then in 2010 and 11, silver had already been going up for years again, along with gold, but, layered type go, advance. Frustrating for the bulls, but still up, up, up. Silver unleashes itself as it has now. I expect in the next couple of quarters, since that spread breakout, that probably you're going to see a dynamite move that will drop jaws. It's not going to be incremental. You're going to a new reality. And it wouldn't shock me that it's in several $100s.
Silver is not returning to its old price reality. According to market cycle analysis echoed by momentum strategist Michael Oliver, silver has already entered a powerful structural bull market. Past collapses now represent sharp corrections within higher ranges, not a return to sub-$50 levels. History shows that when silver breaks long-term spreads, moves are explosive, not incremental. Similar to 1980 and 2010-2011, today's setup reflects years of coiled pressure finally releasing. With silver already multiplying rapidly and technical momentum accelerating, Oliver suggests the next quarters could redefine price expectations entirely, potentially driving silver into the several $100 range and leaving skeptics behind. Now, we present the clips from Michael's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
Silver ebbs and flows versus gold. It goes up in value, down in value, and you can plot it on a chart. And we do it a little differently. We don't do the ratio. We divide an ounce of silver into an ounce of gold, and we get a percent. And if you go back over 50 years, like to 75, and plot what was the best reading that silver had that year, monthly close, versus gold, what was the peak relative performance reading? And we plot it, okay? Well, back in the 79 to 80 bull market in silver, which was still within that range, the half-century range, of $4 to 50, $4 to 50. That surge in 79 and 80, which in the last 5 months of that ongoing bull market already for silver and gold, silver went up 4.5-fold in 5 months, reaching $50 for the first time, 1980. Okay. What caused that already existing bull trend in silver to go ape on the upside and do it bam like that? Totally changed the nature of the reality that was expected. Okay. And then in 2010 and 11, silver had already been going up for years again, along with gold, but, layered type go, advance. Frustrating for the bulls, but still up, up, up. And then suddenly in September of 2010 through April of 2011, so it's 6-7 months, silver doubled in a half in price. In September 2010, it was like in the 20s. Suddenly went to 50 again, bam, bam, bam. And it did it for years of advance. Suddenly in the last couple quarters, it went crazy. Again, stopping at the top of the old, what is now a 50-year range, was a 50-year range. What caused that explosion? Why didn't it just go up to those highs in the same manner that it had been going up already? Why did it go crazy? When you plot the spread of silver versus gold during those times, you'll see that there was like a ceiling. I'm talking technically now. On that spread chart, every month you plot the difference. And there was like a shallow ceiling that prevailed during that bull market of silver and gold, where silver just couldn't get above a certain level in relation to gold. And suddenly it popped above it. And that would have been in like the summer of 1979. And when it did, that's when the price of silver went berserk, quadrupled in a half in 5 months. And then in 2010, it was September of 2010, already going up in price. Silver was in the 20s. And that spread also broke out over a ceiling that any idiot drawing a chart could see if you plot the spread chart the way we do. And boom, in 7 months, it doubled in a half. Okay. Same thing happened this time, except even more clear on the spread chart, even a wider base spanning 10 years of ceiling of silver to gold. Couldn't get above that ratio, that percent. And the November close broke out above it. Bam! Suddenly silver goes crazy. That span of time we find in a lot of other markets, in those rare periods when a market has been stuck in a range for multiple years, decades. Copper did this, for example. It had been in a range from 50 cents to $1.50 in the 1970s, 1980s, 1990s, into the year 2005. And in the latter part of 2005, it broke out above that range, and in a matter of a couple of quarters went to $4.50. Bam! $1.50 to $4.50 on its own. It wasn't associated with, for example, other based metals. It did it on its own. It wasn't even associated with what gold and silver were doing then. A year and a half later, lead did the same thing. You could plot a lead chart going back multiple decades, and it was in its old reality. And when it broke through that, in several quarters, boom, it quadrupled in half in price, all compressed within a couple quarters. Again, on its own, wasn't associated with the copper move even. So we've seen these events occur in other markets where an old price reality, which has existed so long you can't believe it, you're bored by it. You think it's the real reality to live forever. It doesn't. And when the market moves into a new reality, sometimes it does it in an exaggerated manner, in a speedy manner. We know this in other markets, like, we see bubble tops in the stock market, and a lot of people look back on them and say, gee, I should have known that. And sure enough, the collapse that followed was pretty dramatic. Dot-com top to the dot-com, the 2002 low. NASDAQ 100 dropped 82% in 2 years, fully wiping out the entire dot-com bubble, okay? 2007 to 9, similar type process. But the point is that when a market has done something in error, either excessive on the upside or excessive on the downside, in this case for silver, caught in a 50-year range, when you can look at every other market in the world, copper, lead, gold, they weren't caught in that 50-year range. Copper's range was 50 cents to $1.50, and it's living in the 450 level. Now it's 5 something, almost 6. When you stay stuck in that kind of range, and yet silver for some reason stayed in that range for 50 years, despite copper breaking out of its range in 2005, lead in 2007, and gold at each of its bull markets would vastly exceed the prior high. It was 850 in 1980, then it was 1920, and now it's 4,000, et cetera, where the certain banks and association, possibly with central banks, might have been playing a game to try to keep it capped down for some reason. Ultimately, that failed. Okay, but when silver unleashes itself as it has now, I expect in the next couple of quarters, since that spread breakout, that probably you're going to see a dynamite move that will drop jaws. It's not going to be incremental. You're going to a new reality. And it wouldn't shock me that it's in several $100s.
Silver historically ebbs and flows against gold, but spread analysis reveals rare moments when markets enter a new reality. In both 1979, 1980, and 2010, 2011, silver spent years rising steadily before violently breaking above a long-term ceiling versus gold, triggering rapid exponential price moves to $50. Today, that same silver to gold spread has broken out again, this time from an even wider 10-year base. Similar to past breakouts in copper and lead after decades of stagnation, silver's release is unlikely to be incremental. The market is exiting a 50-year constraint, setting the stage for a jaw-dropping multi-$100 silver price regime. Let's get back to the interview.
Point about gold right now, the mama metal. It's not a primarily industrial, it's primary money, okay? You had in the last 50 years since the government legalized it, quote unquote, you had the bull market. It peaked in 2000, but dropped into 1975 when it was legalized. As soon as it was legalized, it peaked and dropped to $103 in mid-1976. That was a bear low, 50% pullback. From that 76 low at 103, it went to 850 in 3.5 years. Okay, 8-fold gain, bear low, bull high. Okay, then for multiple decades, it went sideways, but where? The $200, $300, $400 level. Okay, well off the 850 high, but still way above the old reality prevailed in the 1970s and so forth. In 2001, it made a low at around $260. And a decade later, it was 1920, another 8-fold move, bear low, bull high, under conditions that aren't anywhere approaching the fundamental realities that are now underlying gold. Okay, gold's bear low this time was in 2015 at 1,050. 8-fold, so somewhere about 8,500. Okay, we're 4,500. We're only a 4-fold move. We're only half the dimension of the prior 2 bull markets. What if gold does it again? Which is hardly like a shocking thing to have another 8-fold move. Okay, big deal. Wow. Where would silver be if, let's say, silver now rushes up to, let's say, 2% even, an ounce of gold? Oh, wow. What would that be? 8,000 gold, 2%? You get the point. What if gold doesn't stop at its old eightfold move again because something different's going on this time? And what if silver, instead of going to where it's been in the last 50 years, that relationship has at least been 2% in 20 of the last 50 years. Divide silver into gold, at least been 2%. We saw a low this year at about 1%. Dirt cheap, free silver compared to gold, okay? If silver doesn't just go to the norm of 2%, which it's been 20 years of the last 50, and does what it did during the bull trends, if you go back and look at that spread relationship, in 79 to 80, it was 6.5%. Or in 2010 to 11, it reached over 3%. That's a doubling from where it is right now. Okay, so instead of 2% of the price of $8,000 gold, let's say, assuming gold only does the norm, what about 3%? What about 6%? Which is what it did in the last two bull markets. We're in a bull market now. So wouldn't the spread go up and at least challenge the spread relationship it had in 1980, 2011? Heck, prices above those highs. Why shouldn't maybe the spread relationship also go up and challenge those highs? So the ceilings come off silver, both in its relationship to gold and its own technical situation.
Gold, the world's primary monetary metal, has historically delivered eightfold bull market advances following major bear market lows, 1976 to 1980 and 2001 to 2011. Today's cycle began at the 2015 low near $150, and gold has only completed a fourfold move so far, leaving substantial upside potential. If gold merely repeats history toward 8,000, the implications for silver are profound. Silver recently traded near 1% of gold's price, a historically extreme undervaluation. In prior bull markets, silver to gold spreads expanded to 3%, 6.5%. A return or exceedance of those ratios would signal a structural repricing, removing long-standing ceilings and propelling silver into an entirely new valuation regime. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.